This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 314, and this week, Ben, another great guest and such an interesting topic. The guest was Professor Valentin Haddad, who is the Associate Professor of Finance at UCLA, Anderson School of Management, and boy, really, this one makes you think, but he's a great communicator. Loved the conversation. And elasticity, information and prices, noise in markets. Markets are messy. That might end up being the title. We'll see. And then the inelasticity around large stock prices, the impact of index funds. Like, it just really makes you think. And he's got so many fascinating counterpoints. It almost sounded like there were accidental findings in his research, which is so interesting. So I'll let you kind of tell more of the backstory again. Then we'll talk about his credentials after.
Yeah, you set it up well. We talked about three big chunks. One was index funds and the effect on financial markets, which he's got a paper on. And then we also talked about bubbles and the value of innovation. So like stock market bubbles around the development of new technology. Also an incredible paper on that. And then we also talked about the response of the investment grade corporate bond universe to the COVID-19 crisis, which was extreme. I mean, he talks about how corporate bonds, investment grade corporate bonds, which is like the safest corporate bonds, they dropped around 20% in the US during COVID. Why did that happen? And what does it mean for the safety of bonds?
And what was the impact of the Fed, even without doing much, was really interesting.
Yeah. And was that a good thing for the Fed to have done? I thought his discussion around that was incredible. Anyway, so three topics that are, they all kind of bits and pieces of each one reinforce the other, I think. As we were discussing them, I was noticing that happening in my brain at least.
Yeah.
So Valentin's another University of Chicago Booth School of Business graduate. He's got his PhD and an MBA from Booth. He's at UCLA, like you mentioned. I learned about Valentin from actually Mike Green, because Mike references Valentin's paper on index funds and market elasticity and the relative elasticities of large and small stocks.
Yeah.
We'll let you wait for the episode to understand what I'm talking about. But anyway, so Mike put me onto that paper. I read it. It was incredible. I asked Valentin about a question about the paper, and then I guess I just started poking around his other published research, and I found all these interesting papers. So I asked him if he would like to come on our podcast, and he obviously agreed.
It was great. Okay, so with that, Ben, let's go to our conversation with Professor Valentin Haddad.
Valentin Haddad, welcome to the Rational Reminder Podcast.
Thank you for having me.
Super excited to be talking to you. All right, you've got this great paper on how passive investing is affecting financial markets. So I want to start there. Can you talk about how substantial the shift toward passive investing has been over the last 20 years?
It's huge. So there's different ways to look at it. One way is to just focus on mutual funds. And then you already get, maybe not 20 years, but let's say 30 years ago, there was virtually no passive mutual funds. And now they occupy something like 15-20% of the market. And I think that's just the tip of the iceberg, actually, because there's a lot more in asset management, in like pension funds and so on, that have like slowly shifted away from active strategy. So to give a number, in our paper, we try to just look at how people trade and look who trades like they're passive, and we get something like 40% of the market is passive these days. There's another paper actually that did something kind of cool that looked at like how much people trade on days where we change the indices when we have index composition, and they also find a number like 40% actually. So that would be my best guess, but if I could do 50 or 30%, you would still say it's a big number. So
yeah.
Short answer is it's big.
Who's the other paper by?
By Chinko and Salmon.
Salmon, yeah, okay, I thought so. We've got Salmon booked for later this year for an episode.
Oh, great.
Can you talk about what an investor's demand elasticity is?
Okay, so that's going to be closely related to this notion of being passive. So what people call demand elasticity in economics in general is to say, you want to buy apples, I give you a coupon, 10% of coupon. How much more apples how many more apples do you buy? And then for stocks, you can kind of ask the same question. Of course, you never get a coupon to buy stocks at a discount, but it would be something like, if you see the price of Apple is lower by 1% and you have no idea Apple now the stock is lower by 1% and you don't know why it happened, how many more shares do you buy? How much more do you invest? And that's an important notion because that's kind of telling us how investors are leaning against prices in a way, are trying to take advantage of good investment opportunities.
How does the shift towards passive investing affect the demand elasticities of the investors who did become passive?
Also, it depends what those investors were doing before, but it looks in the data like most investors are providing elasticity. So what it means is when they see some stock being cheap, maybe not surprisingly, they tend to buy some. And so if you become passive, you just shut down this mechanism. You just say, well, I'm just going to follow in the index. No matter what happens to prices, I'm not going to trade. And so that just decreases the elasticity that those investors provide to zero.
Okay, that's really interesting. So we did an episode with Ralph Coyen a while ago, and when we talked about similar stuff about how demand elasticities may have changed over time, and he said something related to what you just said, which is that it matters what people were doing before. And you're saying that in your data, it looks like people are becoming less elastic when they shift into index funds. Is that right?
Yeah.
Yeah, interesting. Okay.
So what we know is for sure at the end, once they switch, they're not providing any elasticities. The question is what were they doing before? And so, like the opposite of providing elasticity would be to be more trend chasers in a way, to buy more when the price goes up. And we know some investors do that, but the average institution the typical institution doesn't seem to be doing that.
Yeah, okay, very interesting. What are strategic interactions between investors?
Okay, so that's the part where like these elasticities become a little bit more tricky in a way, which is that how you trade it's not like buying apples in the supermarket in a way. So when you buy apples in the supermarket, it's just, well, I get a coupon. Do I really enjoy eating apples? I'm gonna eat more apples. For stocks, it's really we're all trying to find good investment opportunities. So it really matters how other people are trading as well. If you know that other people are already very aggressive, already taking advantage of investment opportunities, then there's no point for you to be that aggressive. And so that's what we mean by strategic interaction in a way, the fact that you choose how you trade based on how other people are trading. And so it's not really just, what you like to do, but how you react to others in the market determines how you trade.
Okay, interesting. So it's like an adaptive system kind of thing.
Yeah, pretty much. I think in economics, people like to say like a equilibrium, maybe. In a way, we adapt to each other, we react to each other in what we do.
Really interesting. And why do strategic interactions matter in financial markets?
Also, because they matter for the stability of markets in a way. So one way to think about that is to say, you had a very sophisticated investor, a very active investor that was providing a lot to market. And let's say for whatever reason, they wake up one morning, they have an epiphany, they want to become passive. So they're not there in the market. But what you have to ask yourself, well, is maybe somebody else is going to step in. Somebody else is going to replace them. I think, this is like looking for $20 bills on the floor idea. This is this idea that there's always somebody on the lookout for more. That would tell us there are very strong strategic interaction in a way. And often we think about this as a very big reason that's for stability in financial markets. But of course, it's just an idea. So the point of our research there was to go and see, does this process happen? Do we see this stabilization? That is, if you change how you trade, Cameron, does Ben come to replace you, or do I come to replace you? Or did we just lose you in a way from markets, and markets are different? So that's why it matters for kind of stability.
Okay, I want to keep going on that line of thinking. What is the expected strategic response to a rise in passive investing in a market with fierce competition?
So if you have this kind of old idea or traditional idea, I would say of fierce competition, then there would be a big strategic reaction, pretty much a one-to-one strategic reaction. That is to say, there was an active investors, they were providing, some information, some elasticity, they leave, just somebody else is going to come to replace them. If they were taking advantage of some investment opportunities, somebody comes to replace them. So they should just offset one-to-one. And that's why, historically in finance, we don't think very much about who's trading, who is doing what, and so on. We have decided that the market as a whole is the unit, is what's stable. And underlying this idea is really this principle to say, well, if somebody changes, somebody else will replace them one-to-one. So that's the starting point in a way. That's what I think the idea a lot of us have in the back of our head.
Yeah, okay. And that's I guess the title of your paper, I guess the premise of the paper is really looking at how fiercely competitive is the market actually.
Yeah, exactly. We just wanted to know, well, I mean, to be honest, we all three of us wrote this paper. We come from this long tradition of efficient market, all this stuff. So it's not like we thought this was a crazy idea, but we just wanted to know, well, can we put our hand on this? Like, can we see this in action, and how big is it?
So if the market is fiercely competitive, how does the rise of passive investing affect asset prices?
Well, the answer is deceivingly simple, actually. That is, it doesn't matter. It does not matter at all, because people become passive, somebody else is going to become active. Again, it's like this magic market. Like the market is stable no matter what. There will always be the same. So that gives us a simple answer, a simple benchmark, actually. That is that just nothing happens.
So then the next question is how well does that model of fierce competition hold up in your data?
Well, so not as well as at least you might think. So roughly, if you start from this idea that everything should be compensated one-to-one, we find that about 50%, two-thirds, between 50% two-thirds of these changes are compensated. And so what that means actually shifts, like the rise of passive investing do change the market. So it's like about two investors are leaving from being active, only one replaces them by becoming more active in a way. So that creates large changes, and the market can change over time much more.
And why would active investors be limited in their strategic response?
Well, I mean, I feel not so smart telling you this, but it's hard to trade. It's not so easy. And so, if I tell you, well, one of your competitor has left the market and you want to come in and replace them, well, you have to figure out how to trade. You have to figure out how to identify these investment opportunities. You have to figure out those things. So that's one element. There's another element that is, well, maybe you have a mandate, so you can only do as an institution what you've been told to do, and you can kind of keep going down the line of like there are many frictions that makes that the world is not as easy. First, you have to even know that your competitor has left. When you write our theories in finance, and I'm talking from the side of academia, we imagine that everybody knows everything that's going on, but in practice, it's hard to keep track of those things, of who is doing what. And so all this is kind of like slowing down how people react. You can also be concerned about liquidity. If you become too aggressive, then you're gonna have too much price impact. So you don't want to do that either. And so all those forces are gonna tend to like slow you down from reacting to what other people to be very proactive as an investor.
So is it kind of like a limit arbitrage idea?
Yeah, limit arbitrage is another one. For example, it's risky. So sure, you can find ways to get more profit. It's risky as well. And so there are many such limits in a way that are out there.
So what role do demand elasticities play in determining equilibrium asset prices?
Okay, so now we started from like each of us has our own demand elasticity. Each investor has their own demand elasticity. If you put all this together, that gets you to the market, and so now that's how you would define demand elasticity for a stock or for even the overall stock market. And what that's telling you is how the market overall reacts when there's a change in price. That's not justified by anything else. So let's say, again, one morning I wake up, I want to sell all my shares of Tesla. That's going to tend to push the price down. or the demand elasticity of everybody else in the market is gonna tell us how the market can absorb this. Are people gonna come back and want to buy Tesla a lot when they see the price go down, or not very much? If the market is very elastic, nothing is gonna happen, because the moment I'm gonna sell, the price is gonna drop a tiny bit, and everybody's gonna buy a lot and is gonna buy from me. If the market is very inelastic and investors don't want to trade, don't want to absorb those positions, then it makes it much more, it's going to create a much bigger change in price, because it's going to take a big discount for other investors to step in. So the elasticity of the market is telling us how much the market, again, absorbs shocks, absorbs selling pressure, or buying pressure. Actually, is completely symmetric. So it's telling us how much noise we can have in the market, and how much volatility we'll have in the market.
So if the market becomes less elastic because investors are becoming less elastic, it becomes more sensitive to trading activity or changes in price?
Exactly. Yes, exactly.
Huh. Okay.
So when there's, everybody becomes, if we all become less elastic, if there's the same kind of noise, like noise trading, or people moving for whatever reason, maybe life happens, you have to sell some stocks, then the prices will move more in response to that.
Can you talk more about how, you did mention this, but how individual investor elasticities are related to aggregate market elasticity?
That's just the addition. So this part, there's no, we can strategically respond to each other, but at the end of the day, we each decide how we trade. And if you add up how we all trade, that's how you get the elasticity of the market. So it's simply an addition, pretty much. Of, price goes down by 1%. You're going to buy 5 shares. Cameron is going to buy 10 shares. I'm going to buy 2 shares. Well, that means together we buy, now I lost track, but maybe 17 shares. So you buy, you just add up how different investors react. So that's why, I was telling you those numbers of like which fraction of investors are passive or active. That shows up big time in those calculations.
Really interesting. So what does the aggregate elasticity of an individual stock mean?
So that means when the price of a given stock, so let's say, we were talking about Apple before. So let's say a share of Apple, when the price of Apple drops by 1%, how much more do investors buy of Apple? So this is the issue of elasticity. It doesn't have to be the same answer as it would be for the market overall. For example, when the S&P 500 drops 1%, how much people buy of the overall market? So I think this is something, for example, Ralph Kojen and Xavier Gabex have talked about a lot, kind of like how the market overall responds. In that study, we focus more on kind of stock by stock. How do people respond to one stock moving, another stock price moving? And so that's where we focus.
Okay, interesting. So you're looking less at aggregate market elasticity and more at individual stock elasticity.
Yes. Yeah, so more so, that it's like, do we have a boom or bust in the overall market? Do we start to see different stocks? Again, we don't quite go to mispricing, but in the back of your mind, that's what we have in mind. It's like one stock becomes mispriced relative to another one, or like how do individual stock move more so than the market? That's it.
Okay, so is it relating the individual stock elasticity like relative to aggregate elasticity? Is that
we're not doing too much, actually. So we're just trying to figure out how people trade individual stocks. Because if you think about it, as people switch to passive, I mean, there are many changes happening with this, but a big change is how you trade individual stocks. The first order decision when you become passive is say, I'm not going to choose stocks. I'm not going to make decision across stocks. So that means for a given stock, whoever was trying to trade this stock actively is not doing it anymore. For the market, it's much more ambiguous, actually, because by becoming passive, now you track the market more actively. You might choose to come in, come out of the market. That we leave aside in the paper. We're more trying to think about how people make decisions for individual stocks.
Okay, yeah, interesting. So how do the elasticities of individual stocks vary in the cross section?
So first, they tend to be not so big. So that's the first result that we found that quite a few people have found as well, actually using different ways. So it turns out If you think about price impact in a way of like how much the price of a stock moves when you start selling that stock, it's quite large actually. The second thing we found as we are trying to find those strategic interaction is that actually size matters quite a bit. So somehow large stocks tend to be less elastic, which might be actually quite surprising. Because I think we all have in the back of our mind some idea of like large stocks are more liquid, but it goes a little bit into, well, what exactly does elasticity mean? So let me try to take you maybe through that a little bit, because it's something that I find kind of fascinating actually, and it took me some time to wrap my head around this. So I think the reason we think large stocks are more liquid is we think if I sell $100 of a large stock, I'm going to have much less price impact than I sell $100 of a small stock. I would think that's kind of a fact, and that's a fact. Just to be clear, this fact I'm not going to tell you is not true. But elasticity doesn't really think in those terms. It's thinking more in proportion. So it thinks more about like, well, what if I sell 1% of the market capitalization of a large stock? How much price impact will I have compared to selling 1% of the market capitalization of a small stock? And here you start to realize that, well, it could be larger. It could be even much larger, because if you think about large stock, not many people, like many people buy large stocks, but large stocks are large. So it's more about what is the composition of investors. And in large stock, you have a lot of passive funds, like a lot of the big passive players, of course, hold something like the market. So hold a lot of large stocks. So not many people actually are willing to trade against you if you want to buy large stocks. If you want to sell large stocks, sorry. And so that's kind of how you can see that it could be small. And we went a little bit in the data. We try to see, let's say, within your portfolio. So we zoom out on one institution. And we say, well, within its portfolio, how much does the institution trade the small position that it has versus the large position that it has? And we see the institution change a lot their small position, not so much their large position in a way, because, I mean, that goes back to when we talked about limits to arbitrage, mandates, and so on, is that if you start moving around something that's like 10% of your portfolio, you move it to 20%, you're completely changing the profile of your portfolio. If something is 1% of your portfolio, you make it 2%, that's fine in a way. You're taking advantage of this investment opportunity, but you're not really changing your portfolio. So there's many things that suggest that actually people will trade less aggressively in large stocks, and the market will be less elastic.
Okay, that's interesting. So the large stocks are held by less people who are less aggressive with their large holdings, I guess, in terms of how much they trade them.
Yeah, so it's large. At first order, large stocks are held more by passive investors. Right? So if you think, the very, very big players like Vanguard, State Farm, BlackRock, they are much more highly represented in large stocks than in small stocks. In large stocks, pretty much they hold the market share. In small stocks, sometimes they don't hold them as much because we have a lot of indices that are zooming in on the larger stocks and so on. So already we have more of those investors, and those players, they don't react to prices at all. They're not all explicitly indexing, but mostly they don't react to prices. So that means that, again, if we go back to our discussion of elasticity, there's not much elasticity going on in those large stocks. Again, in numbers of investors, many more investors. In dollars, many more dollars. But those stocks are so large that if you sold 1% of a large stock, you will hit too many passive investors.
Right.
So how have aggregate elasticities changed over time in your sample?
So in what we find a trend that goes with the rise of passive investing. So we find that elasticity that have been going down over time. So again, to go back to how we think about it, some of it is mechanical. If we have passive investors, they have zero elasticity. So they're going to make more and more passive investors means lower and lower elasticity. That's part of what happens in our sample, but there's another part actually that we didn't know for sure was going to happen, but that we found, that is, even active investors tend to become less active, have been trading less and less actively, and that trend actually is less kind of steady in the data. So in what we find that actually pretty much up until the crisis, the 2008 crisis, we would see active investors tend to be we're shifting towards becoming more active. But after that, we've seen a decrease in our active investors are trading. So everybody, we have people becoming formally passive in a way, so not trading actively at all. But even the more active investors seem to slowly be trending down. So that's suggesting that elasticities are slowly going down in the market.
Interesting. So it's not necessarily just a story about index funds. It's like active funds are becoming whatever, closet index funds or something like that.
Yeah, so I think there's
Wow.
some closet indexing. There's some, I think there's been more and more discussion of how even active funds get penalized for having poor tracking error.
Mm-hmm.
I think it looks like there's been a shift in the industry towards trading less actively. The one limitation to that, I'd say, and that's something that research is not quite there yet, is if you went to the very, very extreme of activity, you would get hedge funds in a way, or very levered long short investors. And those typically, like in our data, we don't see very well, and we don't really know. So it could be that those last most active investors are becoming more active. You would have decided that like firms like Citadel, Jane Street have like more and more sophisticated computers, sophisticated algorithm, whatever happens
Yeah.
behind closed doors in those funds. That's possible, but for virtually everybody else, the shift has been to trade less and less actively.
Interesting. What about so you talked about how the large stocks are less elastic than the small stocks. Has the trend, what has the trend in that been like over time?
There's no distinct pattern actually for large stock versus small stock. So everything I described about the markets becoming less and less active in a way is true also in large stocks. Large stocks started less active to start with, so maybe it's a little bit less pronounced, but it's kind of a parallel movement across stock size. So demand for large stock is more inelastic and more so than 20 years ago, but just pretty much by as much as it changed for
Yeah.
small
Okay. Interesting. So what do you think the implications are of your findings for how passive investing is affecting asset prices?
There's quite a few. So there's some we kind of understand. There's some that are harder to measure or to completely get a grasp on. The simple one we understand is that, it's pretty much the definition of elasticity, is that noise will have a bigger effect on markets. So that would tell us that this shift of passive investing is going to push individual stock prices to be more volatile. That we see some evidence in the data. So we try to look at, if I compare stocks that are more or less elastic, the stocks for which the demand is less elastic tend to be more volatile. So that, I think we have a good sense that it's going to tend to push volatility of individual stocks up. The parts that are a little bit more ambiguous, I would think, is what about information, for example? So something people discuss a lot is, our price is more or less informative. Did we and the way I started telling the stories of elasticity, that often people have been think about information in a way that is active investors provide information, make prices more informative. So are we losing information? That's really hard to do. So in our paper, we try to look at some measures of information that other people have come up with, and we don't find much. But it's really hard to tell if it's that nothing is happening, that the measures we use are not that precise. If I ask you guys, like, how would you tell if a price is informative or not? It's really hard to tell. So there's researchers that actually found some pretty clever ways to try to get at that, but it's very noisy. So I'm not quite sure, but I think in terms of concern, that would be the main concern. The flip side of that, though, I think is if you're an investor, in particular a more active investor, it's telling us there might be more investment opportunities out there. And actually, there's this whole idea in finance called the Grossman-Stiglitz paradox that is, this idea that like, if nobody's acquiring information, then markets are very inefficient, and then you should step in a way. So if everybody's becoming passive, there's more gains for being not passive.
Yep.
And I think what I guess our results suggest is that this is kind of happening in a way that is like, well, maybe there are gains to be more passive and more active somewhere, and there would, of course, again, that goes back to our previous conversation, like, well, why don't everybody become active? And it's hard, it's difficult, it's challenging, but I think this is the flip side in a way, that, well, maybe markets are a little bit less efficient, but there are more investment opportunities.
Yeah, it's really interesting. So that's you drew a distinction there between informational efficiency, which is hard to measure, and elasticity. Is there a relationship between those two things, though? Like if the market becomes much less elastic, even if we can measure that it's still informationally efficient, doesn't the inelasticity introduce something like noise, or I don't know what you'd call it?
Okay, so it gets tricky. Let me try to take us through that, and let's try to think through this together. So if the elasticity just measures how you react to the price. It doesn't really tell us why you react to the price.
Right.
And so typically we think that if you're more informed, you can understand why prices are moving. And so when you see the price move for no informational reason, you're going to step in aggressively because you know that's what it is. If I'm completely uninformed, I see the price drop. I don't know if it's because there was bad news about the stock or because it's a good deal. So I will tend to not react very much. So that creates this connection, this very natural connection between elasticity and information. That like the active invest. That's why we think that informed investors are more active. Is that they get signal, they trade based on their signal. When they see the price move for a wrong reason, they come in aggressively, and so on. But it doesn't have to be. I can just be aggressive because maybe I don't know much, but I know I'm just aggressive. I'm an aggressive investor. I'm not very afraid of risk. And so this distinction makes that it's not so easy to know. Now, the other thing you ask in a way is like, well, could the consequences beyond price informativeness matter? I think the answer is yes, but I think it kind of depends even what we mean by price informativeness. So there's two parts in a way. Again, is that one part is the information into prices, and the other part is is only the information into prices. So what I mean by that is there noise as well. So you could have the price moves 1-to-1 when we have a good news, bad news. Like these markets are really smart. There's a ton of noise around this. People make mistakes, and so it might be that the information is still there, but that we have more noise, and the noise is bad, of course, because the noise is really risk for investors that come in and out of the market, and so on. So those two aspects might be somewhat independent.
Yeah, makes sense. You explained that. You explained that well. Connected the dots for me.
This is a really interesting conversation. Do your findings support the concept of a bubble in large stocks due to flows into index funds?
So there's been a lot of discussion of that, and I have mixed feelings towards this, and I'm going to give you the researcher answer. That is, we don't really know, which is not very satisfying as an answer.
No.
So so let me try to say more, maybe it's a little bit more satisfying. So what our findings say is they say two things. They say, well, we have more large stocks are not that demand for large stock is not that elastic, and even less so than it used to be. So that's telling us there's a potential for flows in like kind of irrational flows into large stock to have a big price impact. That's true. I think another piece of the puzzle that suggests this could happen is that, as we said, the passive investors are tilted towards large stock, so they will tend to come in more into large stock. That's not about elasticity. That's just literally about dollars coming into those stocks. There's more investors coming into large stocks. There's been a shift away from smaller stocks. If you put those two together, it starts to tell you, well, that's going to push the price of those large stocks up and potentially too much. The reason I'm a little bit unsure is we don't know if that's the case. We also we don't know if the prices were right before. That's the other thing going on. And we don't have a good sense of the magnitude of those flows. So there's a bunch of ingredients that tells you it's possible, and so I think a few years ago people would have dismissed these kind of like stories, and I think by now we have a grasp that this is possible. But have we seen clear evidence of that? It's difficult to tell. It's like if we think about the large stocks these days, it's plausible there's a bubble. I think at least they're very, very highly valued, and they're companies that are very highly valued relative to their output right now, their profits today. is it a bubble quite yet? I guess it's too early for me to call it, I think.
Right.
So I will not go there. But there are some ingredients that says it could be possible. It's just, I've tried a little bit to think through this algebra, like, well, how many more dollars are coming if I multiply the elasticity, but it's not completely clear to me that it's a very large number.
Does this start to tie into your other research on bubbles and innovation? Do you think?
Yeah, a little bit, yeah. So
Okay.
in that other research, in a way, we're more thinking about what starts the bubble in a way. So
Right.
in that other work, we're thinking more about people speculating, people having different views on stocks. I think the story today for why passive investing create a bubble on large stock is more we have flow of money into large stocks more just because passive investing invests more into large stocks.
Yeah, I'm just thinking about sorry, I interrupted you. I was thinking about alternative explanations for the valuations of those large stocks being so high right now. It could be index funds, but it could be innovation.
Yeah, so and innovation is a little bit of a double-edged sword, I think, for stock prices. Or more, it does two things that go in the same direction, but with different long-term consequences. So innovation, and that was the theme of this other paper we have on bubbles and value of innovation. So the innovation is good. I think that's the first, that's the starting point always is that innovation is good, is valuable. And so when we have lots of innovation, we see these firms getting very highly valued. And, in recent years, we've seen like Tesla and electric cars. These days, I guess we talk a lot about NVIDIA and GPU for AI, etc. The other side of innovation, and that's what got us thinking in that other paper was, well, there's speculation often comes with innovation. That is, we want to know who is the winner. It's like every day we see articles about is like OpenAI going to be the thing we all use, or is it going to be the Google solution, the Llama from Facebook? And so there's this kind of like messiness of innovation that naturally creates speculation. It's like, well, we're all trying to guess or to be informed about who's going to win, and we form views on this. We don't know too much about, 2 years ago, none of us knew anything about AI, pretty much. So,
Right.
but somehow today, I bet we all have opinions about which company is going to be the leader in AI and so on. And out of these disagreements comes speculation, and can come bubbles can come out of this phenomenon as well. That would be the other side of innovation. We're partly high stock prices because of speculation, and partly high stock prices just because the innovation is good.
And we're going to come back to that in a sec, because your research on that is super, super interesting. We're going to dig into it more. But before we go there, on the index fund, the growth of index funds, what regulatory interventions do you think makes, if any, do you think makes sense to address what's going on with index funds?
The first thing I'll say is there's one dimension we haven't talked at all about, and maybe it's my fault, but the first sort of fact about index funds is we had a bunch of people investing in like kind of like random stocks and taking lots of individual risk. Like, forget about how the market works, just for their own personal consequences, taking a lot of risk, and they're not doing that. As I'm a finance professor, like what every finance professor has taught for the past 50 years maybe is we should all invest in index funds. And so at first order, this is a massive gain of welfare, of like a massive positive of passive funds. So I think, even if work like my research points that there can be other consequences, and some of those consequences might be negative, I think we should not forget kind of the elephant in the room, that is, for many individuals' life, this has been progress, that this shift has been progress. So I think my sense is these questions of regulations and so on, they're not quite yet for today. I think that they are on the horizon. It's like if passive funds become more like, you went, from like 5-10% to 40%, if we go to 60, 70, 80%, this might become a problem. We might see, bigger spikes in volatility. We had GameStop a few years ago, or actually, sorry, a few years ago and in the past months as well. Those things might multiply, might happen more frequently, and might become a concern. But actually, I've been thinking about doing research on this to try to know when it's going to become too much. But I think it's hard to forget the part of the trade-off that is just like vast amount of people are just much better off out of more passive investing, and the market might be a little bit different, and that's we should pay attention to that, but that's not necessarily the dominant effect quite yet. It's like I don't think this example of maybe a bubble on large stocks. Of course, if it had a massive crash, could have big consequences. If we saw, if we had a stock market crash that we could really pin on passive fund, maybe, but I think it's way too early to think. I mean, this is not impossible, but it's not very, very plausible at this stage, at least in my mind. And I hope I'm not proven wrong too fast. But yeah.
You mentioned that we hadn't talked about the benefits of index funds yet. I would say that's a key message of our last. This is episode 314 of our podcast. I think that the reason we didn't ask about that specifically is because we've talked about it so much already. So we definitely agree with that message.
And again, that doesn't mean we shouldn't worry about it. And it's very very important for it's extremely important for the economy that markets work well. Again, we'll talk maybe more about my research on bubble and stuff like that. But it's like market crashes that are not always look rational are a big problem. Even booms and busts, mispricing, all these things can have big consequences. They can make firms invest in wrong directions and so on. And I think these concerns with passive investing are very, very are meaningful, but I don't think it's quite yet the time for very strong regulatory call. I mean, clearly regulators should keep track of this evolution. There was, I think a few years ago, there was a proposal to get rid of 13F filings of the publication of 13F filings. So that we can't tell anymore what large investors are doing or what most investors are doing. I think this type of information is important. Is quite relevant to keep track of. But in terms of corrective action of preventing people from investing passively, I don't think that time has come yet.
So just to finish up on this section, what do you think individual investors should do with this information?
Depends how informed they think they are, I would say.
That's such a good answer.
No, but I mean, again, that comes back to this kind of two-sided aspect that is first you can become passive, and that's it. And if anything, that's telling you, because markets have become more fragile in a way for individual stocks, if you don't know too much, you should become more you have even more incentive to become passive than before in a way. And then that goes back to this Grossman cyclist paradox, is that at least but from the point of view of an unsophisticated investor, the more other people are passive, the more markets are messy and hard to understand, the more value, the more as somebody who's not informed, you should go and be passive. And non-informed doesn't mean that you know nothing. That sounds like diminutive. It's the people who are very informed in markets are extremely sophisticated, so it's more relatively uninformed. And so that's saying the flip side again is there are more opportunities that they might be hard to find, but there are more opportunities, and actually I think for a long time we think trading individual stocks is not a great idea. The more I look at this research, the more I think, well, maybe it's not that bad an idea, that you focus on something, you try to learn about a stock and so on. Of course, it's not an idea for everybody, and you need to have a way to get information and so on. I don't mean to say we should live in a world where everybody's trying to pick stocks, but there's something to this in a way, to try to identify situations that large groups of investors have missed, because again there are just less investors around trying to identify these situations than before. So there's going to be some spots in the market that are profitable. Now, I'm not going to tell you how to find them. I don't know how to find them, but maybe somebody can know how to find them.
Right.
Yeah, somebody's going to find them. Maybe. It's interesting though. Maybe not the active funds. So maybe if index funds are growing, active funds are becoming less active. Maybe there are more opportunities for informed individual investors.
Yeah, I mean, look, maybe I should. It's a too big of a can of worms to go in there. But like, if you think about what happened with GameStop, you know, clear. I mean, to me, it's an ambiguous that there was a bubble on GameStop and so on. But it's like the short squeeze that happened. This idea that like, well, a bunch of investors can go and target this short and break this short. Like you could have imagined a few years ago, a couple of active investors do it, and this was something that was led by individual investors. And again, we can have debates on whether short squeeze should happen, whether they should be forbidden. All like this is not my point. My point is, this was possible that this happened, and I think if you had asked most people before it happened whether this is possible, I think they would say no way, for two reasons. Exactly, we would have said first, individual investors cannot matter for anything, but we will also have said if there's a good deal to be made there, active investors will take advantage of it. And it didn't seem like that happened.
Yeah, really interesting. All right, I want to move on to the bubbles and innovation research. I love this topic, and this paper is very cool. How do you define bubbles in your research?
Indirectly. So we don't try to be the true sayer to say we know it's going to be a bubble in advance. But we use a method that some other research actually came up with, and to say, well, if it looks like a bubble, if it sounds like a bubble, if it smells like a bubble, then there's a good chance it's a bubble. So of course we try to be not forward-looking. So it's all based on backward-looking measures, so that we don't cheat in a way and just define a bubble by the fact that it has crash exposed. But we look at episodes like industries where there's been a big price ramp up over the past few years, and at the same time there's been big increase in trading volume altogether. And so what other people have shown is that this is not a perfect way to detect a bubble. There will be lots of false positive, but on average, this is much more likely to be a bubble than a typical episode, this kind of period. So it's a way to say, well, episode where all of us would look at market and say it's a bubble or it's likely to be a bubble, that's what we call bubbles in the data. In our theory, for us, a bubble is an episode where people speculate, disagree, make prices being too high.
So you're taking industry portfolios and then defining a bubble as an industry that's had a big price run up and a big increase in trading volume in recent. Yeah. Okay.
In past, I should have looked at the paper more detail recently, but I think in the past 2 years.
Okay. Yeah. Makes sense.
Both a big run up on. I think it needs to be both a big run up for the industry and relative to the index. So it cannot be just that the whole index is climbing up.
Got it.
How do you measure the value of an innovation?
So here as well, we leverage some research, but that other people have done, but that's kind of a cool idea. So first we should think it's hard to measure the value of an innovation. Like we have like something like ChatGPT comes out. We all understand that it's extremely valuable, but how valuable is it?
Yeah.
One simple way to define that is to think, well, what are the consequences of this innovation? So, you're going to keep track of all the profits that OpenAI is going to make. That's what you could call the private value of innovation. So to the innovator, there's social value also, that like other people will make more profits. So you can think about this in your head. Now, measuring the profits of OpenAI is okay. The other people profits from this innovation already gets tricky. But you can start thinking through that. The idea that we're leveraging up, and that is something that we're going to criticize, is to say, well, you can try to use the stock market. So you could say, well, take the day where OpenAI released ChatGPT. This is not a great example because they were not that public, but take the day where. So formally, what we do is take the day where the USPTO approves a patent by a firm and looks at how much the stock price of that firm goes up when this patent is approved. So this stock price, this increase in dollars, not of one share, but of the total market capitalization, is telling us how much value was created by this patent being approved and released. And there's lots of evidence that people pay a lot of attention to those releases. So that's the way to measure the value of the innovation.
That's the market value of innovation, right?
Like what we call, So in the paper, we try to separate those two values. So in the ideal world, those two numbers are the same in a way.
Right.
The actual realized value and or not necessarily realized, but expected realized value and the market value. And but we in the paper we try to measure the two together to see, well, do they always line up? Starting point was this concern, and we say, well, but when there's lots of innovation, so that's when we really need those measures. There's also lots of speculation, and we start to worry that market prices might be off.
So how does the market value of innovation change during bubble periods?
It goes up. So maybe, I mean, it's not as obvious as it seems, because, we all know during bubbles, like the market values go up, but that's not what we measure. So we measure how much the price change, how big are the price change after the release of innovation. But it turns out those are bigger as well, in a way. The market does like price everything bigger. And so we see these big reactions to innovation. And of course, the part of it should not be unexpected, in that, well, we have big waves of innovation. The innovations are better, so we should see the markets value those innovations better. But I think what we've kind of find out, both through kind of theory and trying to look at different measures, is that it looks like it's too much in a way. So it looks like these price increases are larger than what's justified by the subsequent performance of those innovations.
That is super interesting. So the market tends to respond positively to patents, but during bubbles, the response is more extreme.
Yeah. If you look at, for example, how do the profits of a firm respond to a patent, it also responds positively subsequently, but not more so after a bubble, during a bubble.
Wow.
So we see kind of this disconnect in a way between the markets start to value things a lot, even though they don't have better consequences.
So that's kind of the next question, I think, is what effect does innovation have on real outcomes?
So it has positive effects. So that, I mean, there are large effects. Again, the point of that paper is to point out, some issues, but innovation is valuable and is valuable to firms and so on. But what we find is that in a way the market kind of overvalues those innovations relative to the gain they provide in terms of actual real outcomes, profits, sales, and so on.
So it's like they produce good real outcomes, but when you look back, the stock prices react more positively than they should have?
Yes, exactly.
And how are competitors of the innovative firm affected by the innovation?
So that to us was kind of the flair that really made us think that it has to be a bubble. So when I do an innovation and you're my competitors, this is kind of bad news for you typically. You could say, well, you can build on my innovation, but at first order, I step ahead of you. And so competitors tend to suffer. And so if you look outside of bubble, that you see this phenomenon. So you see the stock price of competitors drop when an innovation patent is approved. And you also see subsequently the sales of those competitors or the profits of those competitors go down. If you look during bubbles, you still see in the real outcomes, you still see that the sales will suffer. You still see that those other outcomes will suffer. But now you don't see a stock price reaction. So in a way, the market is giving too much credit to the firm that innovated, but is not punishing the firms that are suffering, that are the kind of the losers of this innovation process.
Wow. And that's because they're in the same bubble industry?
So the way we thought about it is actually by trying to dissect a little bit what does it mean to be in a bubble, like how do bubble pricing work? So it might be a little bit strange, but bubbles are not just a big mess where people overvalue everything in a way. So the overvaluation is an outcome, but we thought maybe there's kind of method to this madness a little bit of the bubble. So the kind of mechanism we had in mind was something based on disagreement, that different investors have different views on who are going to be the winners. So if we go back, we're talking a little bit about AI. It's like, I might believe that OpenAI is they're the ones that they're going to be the big successful innovators. Versus Cameron you might believe that Meta is going to get all the profits. And so now what this does is that, well, I'm going to be the investor in OpenAI naturally, and Cameron is going to invest in Meta. We start to get this specialization of investor in a way. It's kind of like fan clubs for various stocks. And of course, the fan clubs of each stock is investing in that stock. So now if you start thinking what happens when you get a good news about OpenAI, the people who are valuing it are people like me who love OpenAI. So then the stock price of OpenAI is going to climb up like crazy because they're like, well, I already knew OpenAI was amazing. I get this good news. It's so amazing. Versus Cameron, from his point of view, he's the one that matters for Meta. You're the one that matters for Meta, sorry. And you hear about OpenAI, but you're like, well, OpenAI sucks. This is, who cares? Like, I know Meta is going to be the best, so they can innovate. It doesn't matter to me. So why would I worry? So it's a little bit like, we're going to run a race and we each think we're the best in the race in a way. So if you tell me, if you think you're going to win, sorry, if Cameron thinks he's going to win and I break my leg, he still thinks he's going to win. Or if I get better shoes and I run faster, he still thinks he's going to win. So that's how you get that the competitors don't respond in a way, is that everybody has strong belief into their own firm and competitors don't worry and the firm that innovates gets all the gains.
That's really interesting. It's like the cult of Tesla kind of concept.
Yeah, exactly. Yes. Yeah. But you see both the cult of Tesla and the competitors don't suffer that much, So
Right.
the cult of Tesla tells you why Tesla is going up so much. Again, it's not like we show for Tesla specifically, but if you apply this, the cult of Tesla tells you it's so good, but people like Ford so much. People who invest in Ford like Ford so much, they think electric cars don't matter, so Ford doesn't suffer too much. I think we like these two sides of the same coin. I think is what to us was kind of a big a kind of flare gun to say, well, this is what's going on.
So, what are the implications of this research for, I guess, innovation policy?
So it depends how much innovation you think we should have. So a common view, and maybe the most common view, is innovation is always good in the end. And so what underlies that view is this idea that say, well, there's always going to be good spillovers to innovation. So, when OpenAI, let me not talk about AI actually, because I think there's lots of debate around this these days, but it's like we get better computers. That's going to be good not only for whoever came up with better computer, but like over time, all of us will get more computing power. Everything will get better. And of course, but if you're the person creating the computer, you don't get gains from those spillovers. So there's a common view that there's just not enough innovation. And so then in that view, bubbles are kind of good news because they amplify the incentives for innovation and they create more incentive for innovation because you can have you can ride the bubble and get extra gain in terms of market capitalization. So that's the positive view. And so to say, well, as innovation policy, you should be aware there's a bubble, so you shouldn't overestimate how much innovation is going on. But at the same time, it's good news that innovation is stimulated. The flip side is that the bubble can create kind of overinvestment. So if you're not necessarily so convinced that we always need more innovation, we always need more investment, like if we go back to Tesla, for example, it's like you could say, well, it's great, like this huge Tesla bubble kind of completely accelerated the development of electric car. But the issue though is there's a bubble. So people will lose their job. Tesla will suffer subsequently compared to the peak. And we see sales go down, we see jobs being lost, and these are real consequences that are some fragility, and I think we should also be concerned. So I think the first order message for policy maker was more watch out in a way that you can gain from bubbles, but like at the end of the bubble comes and the long-term gains from the innovation are still there, but many people who partake in the bubble are going to suffer a lot. So you would have to balance those aspects.
So you touched on this, but what are the implications for investors hoping to earn high returns by investing in innovative firms?
Be careful. Be careful. I think like this is an extremely common pattern. So we went back through a lot of history actually. Like it's like not only our data, but we try to read a lot about this, and because people when we talk about bubble, the historical example, people talk about like the tulip bubble, things that are like bubbles on goods that don't matter, like gold bubble,
Mhm.
like. But it turns out a lot of bubbles look more like tech bubbles. Like there's something new and exciting. It's clearly good. It's clearly valuable, and people rush to try to develop the technology. And so sometimes you win, but because the technology comes to fruition, but often there's overvaluation along the way, and prices drop subsequently. I think the other thing to me that is important to realize is it's really difficult to pick winners.
Mhm.
That's why like OpenAI like the AI as AI has been developing, that's something that keeps coming to my mind. It's like OpenAI showed up, nice, a huge firm, and I have nothing negative to say about them. I don't know that much, to be honest. But it's if I ask you, well, in 4 years, is OpenAI going to be the leader of AI? Who knows? If we go back to the beginning, I was thinking like go back to the beginning of like online commerce.
Mhm.
We
Yep.
saw like eBay was going to be the big online commerce. I think eBay was the clear leader. Well, it turns out it's Amazon who won. And so even if you're doing the right bet, if you're betting on the right technology, I think we have a bias of like betting on thinking we can identify who's going to win, and that's something to avoid. I think it's like I would say if you want to bet on AI today, first it's risky because there's likely a bubble, I would say, but also you don't try to pick winners. I think you will have lots of failures along the way.
Yeah, totally. I think there tends to be crazy skewness in technology bubbles where even if you're right about, it's like what you said, if you're right about the industry, it's going to be one firm that drives most of the value creation, and you can't know which one it's going to be.
Yes, exactly. Like it's like these days, I think we would think like so people have different biases or different priors in how they evaluate that. I think many people would say OpenAI is the first one, so they're going to be ahead of everybody else. I think historically that there's no evidence that this is true, but many people think like that, I would say.
Yes.
Yeah.
For sure.
Many other people would think, well, for example, Meta, they have a long, or Google, they have a long track record of success in technology, so they will be able to take them over. That's also plausible, but again, not clear that happens. Often we see new firms come out. So that part, I think, is the part that amplifies the bubble in a way, and is quite dangerous for investors. And I think that investors often don't realize.
All right, I want to move on to one more paper of yours that's in the review of financial studies on fixed income during COVID-19. This another just fascinating paper. Can you talk about what happened in the U.S. investment grade corporate bond market in March of 2020?
It blew up. It completely blew up, and that's so COVID was a terrible period for humanity, I think. Actually, not I think, I know. But something was kind of interesting happening in finance, and I'm a finance professor, so it's looking for the cure for COVID. I looked for that, but something that happened is that so it started like late February, March, 2020. As the pandemic was expanding, markets started to crash, and this is a really unprecedented crash due to its speed. So the one I think many people paid attention to at that time, just because we're used to follow the stock market, was the stock market. So the stock market dropped a little bit more than 30%, and maybe even quite a bit more than 30%
Wow.
over a few weeks. If you go back to 2008, for example, it was a massive stock market drawdown, but it took 6 months, 9 months. The bottom of the market was in March 2010, 6 months later. This was just over a few weeks. So that's already a pretty strong event. But what we found out is that if you look at corporate bond, and so in particular, we looked at investment grade corporate bond, so the safest of corporate bond, their price dropped nearly 20%. And that's unprecedented because stock prices are extremely volatile, but bonds, we expect them to be safe, and safe bonds really safe. So that almost never happened before, such extreme movements. So that kind of got us puzzled. Like you have to imagine, this is the beginning of the lockdown. I'm with my co-authors. We're locked down at home, and we look at the news every day, the financial news every day, and we see this happening. And we had done a lot of work before on like how financial institutions can create crises. We have done a lot of work around the 2000 crisis and so on. But that looked like nothing we had seen before. So we wanted to dig into this some more, pretty much.
And how did the response in the bond market differ from the credit default swap market?
So that's interesting. The way you can think about, this is a simple way to think about bond prices, corporate bond prices. So, the price is going to be down if the company is likely to default. So that would be a natural explanation, at least at first glance, for this period. Is to say, well, we're going to have a big recession due to COVID. Many firms are going to go bankrupt, so that's why we see the price go down. But there's another place where you can get that information. That's the credit default swap market. So there are contracts where investors buy and sell insurance against default. And so if this insurance is expensive, that means that likely the company is likely to default. And we didn't see the price of those insurance go up during that period for those safe bonds. It went up a little bit. I shouldn't say we didn't see it go up, but by a small amount. To give you a concrete example, and that's kind of my favorite example of this period, is to look at, if you look at Google at Google. So Google is an extremely safe company. First, before even I tell you any price number, there's no reason to believe COVID-19 was going to do harm to Google. If anything, this was we all spend more time on computers. This was good news for Google.
Yep.
And if you look at the CDS, or the credit default swap for Google, the price didn't move. So I think it cost a few basis points to insure against the default of Google, something like 50 basis points. It went up a little bit, but if I show you the plot, it looks pretty flat. The price of a 5-year Google bond went down to pretty much 80 cents on the dollars.
Wow.
So that looks like it's pricing a massive risk of default for Google. But again, once you look at everything else, you don't see this risk of default. So we like credit default swap because it's also a price, it's also in the market, and you didn't see this price move. So you just see the price of the bond itself go down. And that's something that told us that something wrong was going on in markets, more so than with the way markets worked, more so than with Google itself.
Man, that's interesting. So you see the bond prices tank. You think it's the price of risk is increasing, but then you look at another place where you can see the price of risk and it hasn't actually changed that much. So what was causing the crash in bonds then?
Okay, so that's where kind of like the detective part of the paper starts. So a natural guess, I mean, actually the natural way you would describe it is that, people don't want to buy bonds, or more precisely, people want to sell bonds, but it's not because the bonds themselves are risky in a way, it's because people want to offload positions. So that's what you would call a fire sale, a massive fire sale going on in this market. And so then we try to ask ourselves, who are the investors selling, and how come this has such a big effect? And here there's a few dimensions you can point to. A big one, maybe the biggest one, and even after our paper, people have done more studies, and I think that's the one that seems the most important, is that bond mutual funds sold a lot of positions. So a lot of bond mutual funds experienced very large outflows. And what a lot of them did, not even funds specialized in more safe bonds, but a lot of mutual funds would sell their safer bonds first. So you have to imagine, even if you have a mix of investment grade high yield bond, you get a big outflow. It turns out the funds chose to sell the more liquid bonds first. The usually more liquid bond first. So kind of everybody went to all those funds went to like the simple rule of thumb, that is, by the way, a good rule of thumb 99% of the time. That is, if you have to sell liquid assets. But it is so much so that then the liquidity deteriorated a ton in those markets. So that's one big aspect, and that's unprecedented, because until that period, pretty much until 2008, we didn't have very big bond mutual funds in the US. I mean, there are some big ones that we know, like PIMCO was actually in bond mutual fund, all this stuff. But most bonds were held through insurance companies, through much more stable institutions. After 2008, we saw this big growth of bond mutual funds, and that is completely kicked back the economy, because with the outflows, there was just massive sales.
So why weren't market participants stepping in to buy the bonds as these prices fell?
So you have to ask yourself, who can step in and try to look for that. So there's various people you can look at. So one category that historically plays a role when there's those like acute episodes are dealers. So the bond dealers, so you think about like large investment banks and so on. So historically, they intermediate a lot of the trading in this market. And so they would say, oh, we have an acute crisis. We're going to buy those bonds, keep them on our balance sheet for a few days. Things will cool down and we put it back. In this case, there were two concerns, I think, that prevented this from happening. One is first a reality that dealers cannot intermediate as much as they used to. We just have much more regulation in the market preventing that. The other one is that this crisis and the pandemic, and it did last quite a long time. So there was a sense that even though it's very acute, it can be a long-lasting problem. So what we would need is investors that can wait it out in a way.
Mm.
So that kind of kicked out the dealers. Like the dealers, even when they had bigger balance sheet capacity, didn't want to take on assets for a long time. So there was a lack of this long-term absorption capacity. Now you could look for other investors. You could say, well, maybe insurance companies could step in. Insurance companies, a lot of them didn't step in. So de facto, they didn't want to step in too much. They tend to be much more stable in terms of their inflows, outflows than bond funds. But they start to worry because as the price of the bonds drop, if it drops too much, the company will go bankrupt.
Mm.
And so it seemed like they were worried and not that willing to participate. Some did participate. I think I might be quoting the wrong one, but I believe like MetLife, for example, did come into this market a bit during that time, but just not nearly enough to stabilize the market. There was not enough capacity to come in. So what was needed at this point was to come in on short notice and to be able conveniently to say, I'm going to come in, I'm going to hold that throughout the pandemic, roughly. And that nobody, it seemed like not many investors were willing to do it. We talked to something interesting. We even talked to pension funds, large pension funds. I guess I cannot tell you which one, but a large pension funds, and they asked us to come talk about this research. And what was interesting is that the people managing the fund were telling us, we knew this. We knew there were good deals. We could see those good deals.
Mm.
But it's just our management was like, it's the crisis. We're not going to suddenly start to switch to buy tons of bonds out of nowhere. We cannot switch our policy. So there's also just a bunch of frictions in a way that makes that a lot of investors cannot move into a market that fast.
Wow, yeah, that's super interesting. Sounds like a job for the Fed. What effect did the Fed's intervention have?
So the Fed did it. So the Fed did step in. Actually, well, did say they might step in. I should say, to be precise. So what happened is the Fed did something they never did before. They stepped into the corporate bond market. So in 2008 the Fed did QE. So that was one of the first time they would say, well, we buy long-term treasuries, we buy mortgage-backed securities. But even after that, I think most people thought this was very limited to treasuries or treasury-like securities. I think there was always this idea that you shouldn't participate in stock market, you shouldn't participate in corporate bond, you shouldn't start to decide which firms are doing better or not. But in a pretty unexpected way, they just stepped in and they said, we're going to create those institutions. So it was the primary market credit facility, secondary market credit facility, and we're going to absorb some of those bonds. And so they said at first they could buy up to $300 billion of corporate investment grade corporate bond. Later, it got expanded in different dimensions, but up to about $800 billion. So that's a big stepping in. And the day they announced that, the market recovers. I think about a third of the crash recovers just that morning, pretty much. What they announced.
Oh. Is that good for markets?
It's a hard question. So actually, I'll tell you about it. So I'll tell you briefly about some other paper we've done, and that's going to amplify. That's not going to answer whether it's good or bad, but it's going to amplify the debate, I think. So they said we can step in up to $300 billion, and later we can step in up to $800 billion. The market did recover, and it turned out the Fed never really stepped in. The Fed only bought something like $14 billion of assets. And everything got by the fall 2020, the Fed is not owning any corporate bond anymore, pretty much. So what happened? So then we have another paper where we think about those issues, and what we think is that there was a possibility that the fire sale could get even worse, and what the Fed did really was to say, well, I'm willing to do whatever it takes to fix it. So it turns out the pandemic was not as bad as people thought it could get. It was extremely bad, just to be completely clear. But it was not as bad as we thought it could get. And so really most of the Fed intervention did not happen. It could have happened, but it did not happen. Okay, so why does that make things kind of worse or more stressful is that the positive side is, well, that's great. They can stabilize market and the experts didn't do much, so then there's not much cost. The worrisome part is, well, they might be willing to step in again. And now they kind of like open Pandora's box and created this implicit commitment. That's another form of Fed put that they will always step in when things are risky. We try to look a little bit in that subsequent research. Do we see traces on that? And we see some traces that suggest a little bit of this. So if you look since 2020, like after the pandemic cooled down, the price of investment grade corporate bond, if anything, seems too high. So it looks, and if you talk, I mean, it's hard to tell, but if you talk kind of casually to a lot of investment grade bond trader, I don't know today, but I haven't talked to them recently, but like even a year or two ago, they will tell you the Fed is in this market somehow like this. Like even though they're not intervening, there's a view that the possibility that the Fed steps in is just propping up the market.
Wow.
And that can be worrisome, that creates moral hazard, that creates issues of the Fed stepping in too much. At the same time, markets are not perfect. Like this is not the crash to start with is not an efficient market phenomenon that we want to let happen. Like it makes sense that we want to fix this. Like the reason they step in so fast is they didn't want 2008 to happen. They didn't want this to spill over somewhere else. So to me, I view it more as like there's a cost benefit trade-off. I think the view, at least in my mind, we're past the world to say the Fed should never intervene in markets. We should always respect market. Like when I look at this episode, everything screams that something wrong is going on in the organization of markets, that there are frictions and that it makes sense for a policymaker to intervene. The problem is that once you come in once, you build commitments to come in again, and those commitments might be costly.
Yeah.
And that only time will tell us.
It's a great answer to the question, but it highlights how messy this system is.
Yeah, extremely messy. Yes.
Yeah, crazy. What do you think the implications of this research are for the safety of bonds in a crisis?
If you look before the Fed, what we learned, I think, from this episode is the corporate bond market is much less stable, maybe than it used to, and that we thought it was. And there's been a big debate actually before even that crisis. So even before that crisis, there was a big debate that is like, if you look at everything about the corporate bond market, it looked much better than before. Actually, it looked much more liquid. Bid-ask spreads were small, and it's because bond mutual funds, ETFs, also like that. We have big growth of bond ETFs, so everybody's trading bonds. The market looks like it's better. But what we learned is that this liquidity is very fragile in a way. That is, you can have these big outflows, and they can destroy everything on their way, pretty much. So that's one lesson. I think the lesson in terms of how to fix it, to us, we keep going back to this thing that what we need is not just better intermediation. So a lot of the lessons from 2008 was intermediation is really important. What I mean by that is like, we need to have a good trading system. We need to be able to move those bonds around fast. In that case, it was not a question of moving the bonds around. It was that we needed the ability to hold those bonds. People often use this analogy of like, the pipes of finance matter a lot. In my mind, that was not the problem. The problem were not the pipes, was that we needed like water tank. Like we need a whole tank to hold the assets for a long time. And I don't think even like, now we're like 3 years out, we've made big progress in having those. So I would still be quite concerned for the stability of those markets were we to have another big negative shock. And again, the shock was not starting in corporate bond. It was just a negative, broad economic negative shocks. And that just propagated in this market.
What do you think is a safe asset in a crisis?
So far, Treasuries have done okay. We saw actually the even Treasuries, there was some notion that there's a safety premium on Treasury typically, that this premium was getting even negative, that people just needed cash. COVID was special in some sense. So I think this episode really highlighted some fragility in the corporate bond market, but I think it's not clear that many crises would look like COVID, because it was a crisis of cash, really. That there was a sense, particularly at that point in time, that a big consequences was that business were going to be closed for a while. This is a world where you have to shut down for a while and open later, so that you need cash, pretty much. That's the only thing you need. You need to like survive for a few months. And that made the only safe asset was cash. At least from the point of view of investors, like nobody knew, like, because this all happened much faster than the horizon at which you need the cash, but that's what I think everybody was looking for. That like clearly we learned that we shouldn't say that it will never happen again, but this is very specific, I think, to this type of crisis. I think many other recessions, even large recession, large crises, don't look like that, and so I think safer assets can hold their safety in those periods.
Our final question for you, Valentin. How do you define success in your life?
Yeah, that's a great question. You told me you were going to ask me, but I I didn't really know. I think I don't think about success that much. I think about happiness a lot, actually. So I think about, am I happy right now? Am I setting myself up to be happy? So I don't really have a very final goal. Like, I feel like when you talk about success, it's like a final goal. I'm trying to enjoy the journey. So a lot of this happiness is at home. Like I have a wife that I love and a daughter that I love, and we spend a lot of time experiencing together. In my work, it's kind of the same. It's I enjoy the journey a lot. Like, it's like I looking for, like, these are very important questions, and I hope I can contribute to the world and to the conversation. But I also enjoy the process of working through those questions. So I think that at least that's my 2 cents philosophy.
It's a great answer.
Great really answer good. For sure. Yeah. Been great to have you, Valentin. This has been an incredible conversation. Thanks for your knowledge.
No, thank you for having me. This was really fun.
Awesome. Thanks, Valentin.